Hello and welcome to The Financial Dad, where I, your average young adult, ask my dad, your not so average financial advisor, all of my burning finance questions. And yes, this is my real dad. In this video, we're going to be doing a deep dive into college savings vehicles. How do you know how much you need to save for college?
Well, it's a calculation. It's a financial calculation. So you have to make some assumptions. You start with what cost of college today would you like to assume you're going to fund for? Then you have to assume an interest rate on the money that you're going to invest.
'Cause it'll go
Investment
up each
return,
year, the cost.
Right. Well, no, that's the inflation rate of the cost. That's the third assumption. So the inflation rate of the cost of college. All of that goes into a computer program, and it will tell you a couple of things. What will be the cost out in the future at the inflation rate that you've assumed, as well as how much money would you have to save every month or every year at that particular rate of investment return to have enough money so that at the end of 4 years, there's a zero balance in a savings account or an investment account for the kid. So that can be done either by programs that are available on the web, or it can be done by financial planners. That's part of what they do.
Okay, great. Let's talk about some college-geared savings accounts.
Okay.
I've heard about a 529
Okay.
account a lot. I'm wondering if you could give us just like a brief description of what that is.
Yeah, sure. A 529 account is probably the most popular savings vehicle used anymore for college. It has several major advantages that have made it so popular. One is that a large amount of money can be gifted into it every year. The second is that all the money in it grows tax deferred. So whatever the investment earnings are over time, you don't have to pay taxes on it year by year by year.
So you don't have to pay an income tax.
An income tax on that money. The third is that if it's used for an educational purpose out in the future, when a child goes to college, let's say, you don't have to pay any income taxes on the money that you take out. So whatever the gains are from the point where you've invested the money to when you take it out for a college purpose, let's say, you don't have to pay any income taxes on the growth on that money over that time. And that could be a substantial benefit, not to have to pay those taxes.
Because as opposed to in just a normal investment account, you'd be paying taxes on all of the money you're making per year on the investments.
Subject to certain limitations of the law, but yes, exactly. And 529s, more money can go in. So you would otherwise be paying all of the other options. You would not be able to put in as much money or save as much in taxes.
Okay. Well, that sounds like a pretty good option. Let's talk about a UGMA account.
Okay.
Would you mind telling us what that stands for?
Uniform Gift to Minors.
Okay.
So there are two different kinds of accounts, and it depends on the state you're in. Uniform Gift to Minors, or UGMA, is one. Uniform Transfer to Minors Act is another one. They're basically the same. It just depends on what state you're in.
Okay. Basically different names, slight difference. Got it.
Yep. Now, these are similar to the 529 in terms of how much can be gifted per year, except that with a 529, you can actually sort of front-end load 5 years of gifts into a 529 plan, but you cannot do that with a UGMA or UTMA account.
What would constitute as a year's worth of gifts?
$17,000 a year from each person. So two parents can do $34,000 a year to each donee, each person that you donate it to.
So whoever is trying to go to college,
whoever you're trying to fund for, and however many children you're trying to fund
so for a 529 plan, you'd be able to use 5 times that amount and put it in 1 year.
Right. So if you have two grandparents, for the sake of argument, and one grandchild, the parents could put in 5 times $34,000 right up front. You can't put any more in over the next 5 years, but they could put in over $150,000 basically.
Which would grow faster.
Right, because you have that much more money.
Amount.
Correct.
Okay.
That much more money growing.
I see.
Back to the UGMA.
Yeah. How do taxes affect those accounts?
Yeah. So there, the taxes are the investment earnings are taxed to the child.
Okay.
So the first $1,100 or so is tax-free, zero tax. The next $1,100 of investment earnings are taxed at approximately a 10% rate. So effectively, between those two, if you had exactly $2,200, $2,300 of investment earnings, you'd pay about a 5% tax on that. So, I mean, you could put in somewhere between probably $25,000 to $40,000, you could have that much money in there
and not be
and
taxed
pay
until
virtually no tax on it.
$41,000.
Until $2,200 of income
Yes.
on it, right? So it could be good for certain situations. There's one more main difference between it and a 529. In a 529 plan, the investment options within it are fairly limited. The money is really managed by the company that puts the 529 plan together.
So that might be a good option for someone who doesn't have as much awareness of the market.
Correct. If somebody is sort of oriented towards stocks, let's say, likes to pick stocks and wants to have individual stocks for a child, a UGMA account is a good way to do that because they can pick whatever stocks they want to and let it grow, for the child. Say you work for a fast-growing tech company or something like that, and you'd like to buy some of your company stock and have your child own it, or even gift some stock you already hold to your child. You can do that with a UTMA or UGMA.
Oh, I mean, that sounds useful too. I'm wondering, with both of these accounts, how do they affect consideration for financial aid?
Okay.
Federal financial aid.
Yeah, they're treated differently. The balance in the account, 5.6% of it is considered to be available for funding college. But with a UTMA, 25% of it is considered to be available to fund college.
Okay.
So there's an advantage with the 529 plan.
Because you're more likely to get more benefits.
You get more financial aid. You'll probably get more financial aid.
I see.
All other things being equal.
Well, speaking of ownership, let's talk about who owns each account.
Okay.
So in a 529 plan, who owns that account?
The donor, the person who put the money in.
Got you. So that would be the parents, grandparents, whoever is.
Yeah.
And then what about with the UGMA or UTMA?
Well, technically, a custodian owns the money, meaning the really means the person who put it in, but they hold it for the benefit of the child. So it's really the child's money more or less. And when the child becomes of age, majority age in whatever state they live in, it could be 18 or 21, at that point, the money is the kid's money.
Okay.
The kid can do whatever the kid wants to. With a 529 account, at those same ages, the money still belongs to the donor. It doesn't have to be given to the child. It doesn't immediately become the child's money.
Interesting. Now, let's talk about, I've heard of a Coverdell educational savings account.
Okay.
How would you say that differs from the other accounts
Well, it's a bit of a mixture of the two with some limitations. First of all, like a 529, money that you put into it grows tax deferred, and if it's used for educational purposes, when it comes out, it is tax-free when it comes out. So it has that benefit. The downside, the other benefit that it has, like a UGMA account, is that you can invest in it any way you choose. So if you want to buy stocks again or something like that, you can do it there. The biggest downside is that you're limited to $2,000 a year of a gift into it, of contribution to it.
So it's much smaller.
Much smaller than the $17,000, or for a married couple, $34,000 versus $4,000 a married couple could put in to two people for one kid. So, that limitation has made the Coverdell it's not very commonly used anymore. Simply because you can't, with the cost of college today being as high as it is, $2,000 doesn't get you very far.
Much. No, it doesn't. Would you say it's more useful in a supplemental way? Like you add it on to having one of the other accounts?
If you could gift more than $34,000 a year and you want to put some more money away, you could use that. Yep.
Okay. So besides, let me backtrack a little bit. How does the Coverdell account affect FAFSA at all?
That's treated like the 529 plan.
Okay.
For FAFSA
so
5.6%. 5.64%, correct.
Besides these, are there any other accounts that you could use towards saving for college?
Well, the main other accounts are just general savings and investment accounts that would just be like any other account that you would have that isn't specifically about college, and there are no specific tax advantages, no specific gift limitation differential. It's just, like any other investment account that you might do for a child. You could keep it in your name, or you could put it in the child's name, and so, but
Take it out
it's fully taxable.
Use it for whatever you want, but then
correct.
you don't have the tax benefits.
That's correct. That's correct.
Is it possible to have more than one of these plans at the same time?
Absolutely.
If you can afford that?
Yep.
Okay. And what would you say is the most important element when saving for college? Besides like choosing different accounts, what would you say is the most important?
I would actually go back to your original question, which is, what do we need to save? We had a separate question when we did a life insurance video, which was, how much life insurance do we need?
Yeah.
We're not just picking a random number because we think we can save a certain amount and hoping it gets us somewhere. It's important, from my perspective, for people to know what these numbers are and to make logical decisions, even if they can't afford to fully fund it, to make logical decisions based upon that knowledge, and to understand that if they choose not to fully fund it, they're choosing to spend money on something else, typically, unless they just simply absolutely can't afford it. And that is the case with
And that's
a
where
lot of
financial
people.
aid would
In the
start
future,
to
you're
help,
hoping for financial aid.
Yeah.
So we actually have an example of how a whole bunch of financial aid would come into play in a separate video on college scholarships and loans.
That's the next one, so
The
tune
next
into
video.
that one. Overall, it seems to me that time is the most important thing. The earlier you start, the better chance you have of reaching the financial goal of whatever you're trying to save up for.
Yes, it's very true. This is the same concept as retirement planning. The earlier you start to put money away, the less money you'll ultimately have to put away because money compounds.
Yeah.
Another one of our things, compound interest, compound return. So the longer it's there, the more that money is compounding in value, the less money you have to ultimately put into it. So yes, many people, financial planners will tell you, the child's just been born, get started. Start saving money. There's no better time than the present.
Yeah. And how do you open one of these accounts? Do you go to a bank? Do you go to a financial planner? Where do you start?
Yeah, most of these are in some way or form a brokerage type of situation. So
investment.
It's going to be some kind of a brokerage arrangement. Some banks have brokerage arrangements, but financial planners, investment advisors, people like that are the ones that have access to these. You can also go directly to discount brokerage firms and open accounts there as well.
Okay. Well, this has all been very helpful. That's all for our college savings video, but make sure to tune into the next one where we're going to talk all about scholarships and financial aid. Thanks so much for watching this video. If you have any questions for us, feel free to reach us at our website and make sure to click on to the next.